It's getting cold. We're starting to think about gas storage. We're going through it pretty fast. How fast are we going through it, and how big a problem could this be?
Good morning. So we're on a trajectory that matches what we saw in 2016-17 and then 2017-2018, where we ended the winter season at 10 to 20% stock levels. When we compare that to where we've been since Russia invaded Ukraine, it's a massive difference. Already the market seems to be thinking that we could be as low as 35-40%, but to come that low, it really puts pressure on imports. And when you have storage dip below 30%, your withdrawals are less efficient, so you can reach that bottom very quickly. In addition, we don't have floating storage of LNG available offshore like we've had the last 2 winters to prevent price spikes if there are production outages for TTF.
So how do we refill? Presumably, if we don't have Russian pipeline gas, that's going to be more tricky. How much extra LNG do we need, and how much capacity do we have to refill via the LNG route?
So if we start with what we know, right now, Russia is no longer transmitting gas through Ukraine. To replace those volumes, which is 15 BCM, that means 1 LNG cargo entering Europe every other day. For that, we have ample capacity. It can very easily be done. If we're down to these low stock levels that I described, we could face demand for up to 400 additional LNG cargoes needing to come into Europe to hit that 90% target on storage for November 1st.
I mean, Nadia, good morning, it's Lizzie. Do you think that the real issues start next winter as you get the storage withdrawals now? I was talking to Javier Blas on Bloomberg Opinion about this yesterday, and I think you're even more pessimistic than him about where the storage levels drop to.
Absolutely. I think that we've just seen how cold weather really draws it down quickly. And we're in a situation that we've already had a lot of demand destruction. Right? So it's not where we were in 2022. So this need for LNG is much stronger this time. And this is, of course, for next winter. But that mandate for 90% levels of storage, that comes from the EU. There are some very big penalties in certain countries if you don't reach that. And the feeling amongst the trading community is that if storage holders don't do it, then the TSO will do it. And when we look at the shape of the natural gas curve in TTF, we can see that summer prices are still very, very high. We don't have the contango we should to build that storage. So it's really looking to be an issue already in the summer to prepare for next winter, not waiting until next winter to really have the shock.
So we're talking about the US ramping up production to make up for this lost Russian gas through Ukraine, to keep Europe supplied. Where do you see it flowing to mainly?
So when we look at last year, US exports of LNG went #1 to Europe, especially the Netherlands. Then it went to Asia, Japan, South Korea, India. What we saw is overall imports of LNG to Europe were down year on year. But then that was immediately almost 1-to-1 replaced by this extra Asian demand. When we look at what we see in extra production coming out of the US, it perfectly can match what is no longer transmitted via Ukraine from Russia. However, when we're looking at rebuilding the entire storage situation, that would probably require LNG from all sources, even possibly including Russia.
Nadia, when we traditionally talk about LNG, we're doing it from an energy perspective, from a heating perspective, certainly an export perspective. Today's kind of big theme on the show is a lot of the tech story and the data build out, the AI build out. There's a narrative in the States that to do that, to kind of fund that AI growth, to fund those data centers, and also to supply the energy needed to make that sector thrive, natural gas is the way to do it. What does that outlook look like, and how much of a tailwind is it for pricing in that sector?
Absolutely. We believe at Svelland Capital that natural gas is the reliable, fast solution and least expensive solution to have these data centers up and running. When we look at where prices have been in Henry Hub, though, we saw curtailments in production last year. When we're at 3.5, $4 for MMBTU, then we start to see production coming back. And this is where we've been waiting to see Marcellus really ramp up production. But right now, there's such a cold snap in the US that instead of increasing production, we now have cuts to production. Last year, we had a massive cut to production. Granted, it was short term, but this is where we need additional infrastructure build out to make it more across the lower 48 to bring that going forward for the next 5 years.
Nadia, what does that relationship then mean for the oil sector, especially in the United States, again, where so many of the utilities that used oil as kind of that power generator and that commodity for the reasons you just outlined in terms of just how expensive it can be, have switched to natural gas? What does that mean in terms of the correlation between oil and natural gas from a pricing and trading perspective?
Well, they will be increasingly related. And what we also see is when natural gas prices get very high, we see switching back. And so that can continue to happen. One thing that is very helpful for the oil sector is that a lot of shale production has associated gas. With higher gas prices, even where they are just a little bit higher on Henry Hub, it means that producers will be able to produce more oil with less high oil prices and still be above their break-even prices. So it should help the entire sector together, hand in hand.